Hello, astute traders and market watchers. Welcome back to the channel where we dive deep into the fascinating world of how to borrow stocks and the mechanics behind a potential short squeeze. Today, we're putting a very specific company under the microscope, NCRA Inc., trading under the ticker NCRA. We'll explore why the stock has landed on our hard-to-borrow screener with some truly eye-popping numbers. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. NCRA Inc., or NCRA, is a company operating in the consumer defensive sector, specifically within packaged foods. They're an acquisition-focused firm, providing land-based recirculating aquaculture system services, engaging in fish farming, selling aquatic products, and producing food products. Essentially, they are involved in the growing field of sustainable aquaculture. Currently, NCRA is a microcap stock with a market capitalization of just $2.05 million. It's important to know its current trading behavior. Today, NCRA is down 3.5%. Looking at the past 5 days, it's seen a nearly 20% decline, specifically down 19.70%. And over the last 30 days, the stock has dropped a significant 79.46%. Volume has also been notably low, with today's volume at 188,600 shares, which is only about 0.1%'s 30-day average volume of 1,272,312 shares. What is cost to borrow and why it matters? So, what does it mean for a stock like NCRA to be hard to borrow, and why should you care? When you want to short a stock, you first have to borrow shares from someone who owns them. The lender charges a fee for this, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. The higher this fee, the more expensive it is for short sellers to maintain their positions. Think of it like paying interest on a loan. A high CTB indicates strong demand to short the stock and or a very limited supply of shares available to borrow. Why this stock is hard to borrow right now. Now, let's talk about NCRA's specific numbers that caught our attention. NCRA currently has an annualized cost to borrow fee of a staggering 1093.1%. Yes, you heard that right, over 1,000%. To put that in perspective, anything above a few dozen percentage points is considered very high. This isn't just a high number, it's a rapidly rising one. Over the last 5 trading days, NCRA's CTB momentum has jumped by an incredible plus 973 percentage points. Joe chart, CTB over 5 days was contributing to this. Currently, there are only 6,000 shares available to borrow. When you consider NCRA's estimated float is just 0.2 million shares, having only 6,000 shares left means the borrowable supply is incredibly tight. Our internal composite squeeze score, which factors in CTB level, momentum, borrow supply, float, and technicals, currently gives NCRA a score of 56.2 out of 100. Squeeze mechanics explained. When a stock becomes this hard and expensive to borrow, it sets the stage for what we call a short squeeze. Here's how it works. Short sellers bet that a stock's price will go down. If the price starts to rise unexpectedly, or if the cost to borrow becomes unbearable, these short sellers might be forced to close their positions. To close a short position, they have to buy back the shares they initially borrowed. This buying pressure, especially from a large number of short sellers trying to exit simultaneously, can rapidly drive the stock price even higher, creating a squeeze as more shorts are forced to cover. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price will eventually fall, and they are willing to pay a premium to maintain that bet. Dilution risk check. It's vital to assess any potential headwinds. For NCRA, our dilution risk check raises a flag. Recent SEC filings show a registration statement within the last 90 days. Show SEC filing example, this could be ins-1, ins-3, or 424B filing, indicating the company has registered shares for potential future sale. Why is this a concern even with high CTB? Dilution, simply put, means more shares are added to the market. If a company issues a large number of new shares, it increases the total float. This additional supply can absorb any buying pressure from short covering, effectively offsetting or even negating a short squeeze thesis, even when the cost to borrow is sky high. So, while the CTB on NCRA is extreme, this dilution risk needs to be carefully considered. Recent reverse split watch. Another critical factor for NCRA is its very recent reverse stock split. Just 5 days ago, on July 7, 2026, NCRA executed a 1/30 reverse split. Show chart, price action around split date. A reverse split reduces the number of outstanding shares and, consequently, reduces the float. It also proportionally increases the share price. For example, if you had 30 shares at $1 each, after a 1/30 reverse split, you'd have 1 share at $30. Historically, many microcap stocks that undergo reverse splits tend to see renewed volatility or a price pop within about a month after the split. This is a pattern we've observed in some names, not a guarantee for every single stock, but it's certainly a factor that can contribute to short-term speculative interest or short-term price movements, especially when combined with a tiny float and astronomical borrow fees like NCRA's. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given NCRA's unique setup, a staggering 10.93% CTB, only 6,000 shares available, a minuscule 0.2 million share float, and a recent reverse split, here is what to keep an eye on. Watch the available shares to borrow. If this number continues to shrink or dries up completely, it could exacerbate the situation for short sellers. Monitor the daily volume. If a sudden surge in buying volume comes in, especially on light selling pressure, it could be a catalyst. Also, keep the dilution risk in mind. Any news or indications of new share offerings from those registered shares could quickly change the landscape. NCRA Inc. NCRA presents an interesting case study with its extreme cost to borrow and tight float, particularly in the wake of its recent reverse stock split. While the conditions for a short squeeze appear technically potent with those borrow fees, the existing dilution risk and the overall bearish price action over the last month remind us that these are highly speculative scenarios. Always remember, high risk, high reward potential, but also high risk of loss. If you found this deep dive into NCRA insightful, please hit that like button, subscribe to the channel for more unique hard-to-borrow stock analyses, and let us know in the comments below what are your thoughts on NCRA's current situation. Do you think the high CTB will lead to a squeeze, or will the dilution risk outweigh it? We love hearing your perspectives. Until next time, stay sharp, stay informed, and trade safely.